Welcome back to the channel. Take a breath and really lock in right now, because what I'm about to break down is not hype, not a rumor, and not some short-term price prediction designed to grab clicks. This is about a structural shift in global liquidity that has quietly powered markets for years and is now starting to reverse. If you understand this shift, it will completely change how you look at XRP, Bitcoin, the broader crypto market, stocks, and even real estate over the coming months. Most people think markets move because of headlines. They don't. Headlines come after the damage is already done. Markets move because of liquidity, where money is coming from, how cheap it is, and where it's flowing. When liquidity expands, almost everything looks like a good investment. When liquidity contracts, the truth comes out fast. And right now, we're entering a phase where liquidity isn't just slowing down, it's changing direction. Crypto is especially sensitive to this, more than stocks, more than bonds, more than real estate. Crypto is a liquidity amplifier. When money floods the system, crypto explodes higher. When money gets pulled back, crypto doesn't politely drift lower. It snaps. That's not a flaw in crypto. It's the nature of an emerging high beta asset class that still sits on the edge of the global financial system. Here's the mistake most people are making right now. They're zoomed in on charts, candles, and daily price action while completely ignoring the macro engine underneath everything. They're asking whether XRP can hold a support level or whether Bitcoin will bounce next week, instead of asking the only question that actually matters in this phase: where is liquidity coming from and where is it going next? For years, global markets have been supported by a massive source of cheap money that very few retail investors ever paid attention to. It wasn't visible on a chart, it didn't trend on social media, but it quietly propped up asset prices across the world. Stocks, bonds, property, and eventually crypto. When that kind of money is flowing, risk feels safe. Valuations stretch, speculation thrives. People confuse liquidity with intelligence, but liquidity cycles don't last forever. They never have. And when they turn, the effects are rarely clean or orderly. The early stages always look confusing. Prices chop, volatility spikes, narratives clash. Bulls and bears both feel uncomfortable. That's usually the signal that something bigger is shifting under the surface. What makes this moment especially important is timing. We're not in a euphoric blow-off phase, and we're not in a full-scale panic either. We're in the transition zone, the phase where smart money starts adjusting quietly while the majority stays distracted. Historically, this is where positioning matters far more than prediction. And no, this doesn't mean everything is about to collapse overnight. Markets don't work like that. Large players don't panic sell. They rebalance, they reduce exposure, they unwind leverage slowly. And that slow unwind can be far more dangerous than a single crash, because it grinds confidence down over time and forces weaker hands out of the market. This is also why this phase feels frustrating. Rallies fail, good news doesn't stick, bad news hits harder than expected. People start questioning long-term beliefs, not because fundamentals suddenly changed, but because liquidity is no longer doing the heavy lifting for them. For XRP specifically, this matters a lot. XRP doesn't exist in isolation. It trades inside the same global risk environment as everything else. Even if long-term adoption continues, even if infrastructure keeps building, short-term price is still dictated by capital flows. Ignoring that reality is how people get blindsided. The goal of this video isn't to scare you. Fear without understanding is useless. The goal is to put the current market in the correct context, to help you see why price action over the next several months may not behave the way social media expects it to, and to prepare you mentally for volatility that isn't random, it's structural. Because the worst position you can be in during a liquidity shift is confusion. Confusion leads to emotional decisions. Emotional decisions lead to selling bottoms and buying tops, and that's how wealth gets transferred in every cycle. For years, one of the biggest drivers of global liquidity wasn't something you'd ever see trending on crypto Twitter or flashing across financial news headlines. It was a quiet, almost boring mechanism that institutions relied on to move massive amounts of capital across markets without drawing attention. And the reason most retail investors never learned about it is simple. If you understand where liquidity actually comes from, you stop chasing noise and start anticipating cycles. That mechanism is the yen carry trade. For roughly 2 decades, Japan held interest rates near zero, not low, effectively free. That created a situation where global investors could borrow Japanese yen at almost no cost. convert it into dollars, and deploy it into higher yielding assets elsewhere. US treasuries, equities, real estate, private credit, and eventually crypto all benefited from this flow. The trade was simple: borrow cheap, invest higher, pocket the spread, and then leverage it further. This wasn't some fringe hedge fund trick. This became a structural pillar of global markets. Trillions of dollars moved through this channel over time. Hedge funds used it as base capital. Banks used it to optimize balance sheets. Large players borrowed against borrowed money, stacking leverage on top of leverage. And as long as the interest rate gap stayed wide, the trade kept working, liquidity kept flowing, asset prices kept inflating. The important part is this: that liquidity didn't just boost safe assets. It pushed investors further out on the risk curve. When money is cheap and plentiful, risk tolerance explodes. Tech stocks stretch valuations. Real estate becomes speculative. And crypto, being the most liquidity-sensitive asset class of all, absorbs that excess faster than anything else. That's how you get explosive upside during expansion phases, but it's also how you build fragility underneath the surface. Now here's where the shift begins. The yen carry trade only works when borrowing in Japan is dramatically cheaper than borrowing elsewhere. That gap is what creates the arbitrage, and that gap is now closing. Japan has begun raising rates to defend its currency and regain control over inflation, while at the same time the Federal Reserve is signaling a move toward lower rates in the future. The free money era, at least in this channel, is ending. Once borrowing costs rise and returns compress, the math breaks. Positions funded by cheap yen no longer make sense to hold at the same size, not because institutions suddenly change their beliefs, but because risk management forces their hand. Capital that once flowed easily now has a price attached to it, and when that happens, positions start getting reduced. This is the part most people misunderstand. Liquidity doesn't disappear in a single event. It unwinds. Slowly at first, then more aggressively as feedback loops kick in. Large players don't dump everything overnight. They rebalance, hedge, and unwind exposure over months. But even controlled selling changes market behavior. It suppresses rallies. It increases volatility. It makes markets feel heavy. And when liquidity is leaving the system, fundamentals take a backseat in the short term. Assets don't move based on what they might be worth in 10 years. They move based on who needs to sell today. That's why macro liquidity shifts hit risk assets so hard, not because those assets are broken, but because they were beneficiaries of leverage that is now being reversed. This sets the stage for what crypto is about to experience. Not chaos, not the end of the market, but a period where capital becomes selective, leverage gets punished, and price action feels disconnected from long-term narratives. In the next part, we're going to connect this directly to crypto and XRP and break down why liquidity unwinds historically create outsized volatility in this space, regardless of how strong the fundamentals look on paper. Now, this is where everything starts to hit closer to home for crypto, because when liquidity unwinds, crypto doesn't just react, it exaggerates the move. This market is not built like traditional finance. It's thinner, it's faster, and it's far more sensitive to leverage. That's why every major macro liquidity shift shows up here first and with more violence. When carry trades begin to unwind, the first thing that happens is forced risk reduction. Institutions don't wake up one day and decide they hate crypto. They simply have to free up capital. Assets that were bought with borrowed money suddenly become a source of funding rather than opportunity. And crypto, being liquid 24/7 and globally accessible, becomes one of the easiest places to raise cash. This is why fundamentals don't protect price in the short term. You can have the strongest narrative in the world, active development, partnerships, adoption. None of that matters when liquidity is being pulled. Price action during these phases is driven by positioning, not belief. Whoever is over-leveraged gets flushed. Whoever relies on constant inflows feels the pain first. Historically, reverse carry trade environments have amplified volatility across all risk assets, but crypto has always been the most extreme expression of that volatility. We've seen it repeatedly. When global yields rise and funding costs increase, leverage positions unwind aggressively. Bitcoin sells off sharply, altcoins follow with even larger percentage moves. This isn't because crypto is failing, it's because crypto was one of the biggest beneficiaries of excess liquidity on the way up. XRP sits inside this same environment. While it may not be as leverage heavy as some assets, it remains tightly correlated to broader crypto and equity markets during macro stress. When stocks de-risk, crypto de-risks. When crypto delevers, XRP feels that pressure as well. Correlation goes to 1 in stress events. That's not theory, that's data. This is where a lot of people get emotionally trapped. They see price falling and immediately assume something is wrong with the asset itself. In reality, what's often happening is forced selling unrelated to fundamentals. Liquidity-driven drawdowns don't ask permission. They don't wait for narratives to make sense. They overshoot, they scare people out, and only then do they stabilize. From a technical perspective, these phases tend to break levels people thought were strong support. Not because those levels were meaningless, but because liquidity doesn't respect technicals during deleveraging. Support becomes temporary. Bounces become weaker. Volatility expands. This is why relying on "I'll just sell if it breaks" is one of the most dangerous assumptions you can make. When everyone tries to react at once, execution disappears. Another critical point most retail investors miss is time. Liquidity unwinds don't resolve in days. They stretch out. Institutions unwind positions gradually to avoid destroying markets, but that slow pressure suppresses upside and creates a grinding, frustrating environment. Rallies fail. Sentiment erodes. People lose patience. That's exactly how markets shake out weak hands without a dramatic crash. For XRP specifically, this means you have to separate short-term price behavior from long-term viability. Liquidity contractions can push price far below where fundamentals would suggest it should trade. That doesn't mean the long-term thesis is invalid. It means the market is repricing risk, leverage, and exposure across the board. This is also where probability matters more than precision. You don't need to predict the exact bottom. You need to understand that during liquidity stress, downside risk expands before opportunity appears. Markets rarely reward early optimism. They reward patience after excess is cleared. So the mistake to avoid here is denial. Pretending XRP is immune to macro forces is dangerous. At the same time, assuming a drawdown equals failure is equally wrong. Liquidity-driven sell-offs are part of how markets reset. They feel irrational because they are mechanical. If you understand that, you stop making emotional decisions based on daily candles and start thinking in phases. Deleveraging, stabilization, reaccumulation, expansion. Every cycle follows that rhythm, even if the headlines make it feel chaotic in the moment. Now let's zoom out, because if you stay trapped in short-term volatility, you miss what these phases are actually designed to do. Markets don't punish everyone equally, they punish excess. And liquidity contractions are the mechanism that forces that punishment. This isn't random chaos, it's a filter. Every major cycle follows the same arc. Easy money fuels expansion. Expansion breeds speculation. Speculation breeds leverage, and leverage eventually creates fragility. When that fragility is exposed, capital doesn't disappear forever. It reorganizes. It moves away from what depended on constant inflows and toward what can function even when attention fades. This is why downturns feel brutal but necessary. They strip away projects that only existed because liquidity allowed them to exist. They expose business models that can't survive without perpetual growth. And they force participants to distinguish between what they believe in and what actually has staying power. For crypto specifically, these phases are where the market matures. Early cycles were driven almost entirely by retail speculation. Later cycles increasingly involve institutions, custodians, and regulated entities. That shift changes behavior. Institutional capital is slower, more deliberate, and far less tolerant of chaos. It doesn't chase narratives. It waits for clarity, structure, and survivability. This matters for XRP because XRP sits closer to infrastructure than pure speculation. That doesn't make it immune to drawdowns, but it does place it in a different category when markets begin rebuilding. Assets tied to payments, settlement, and regulated financial rails tend to re-emerge earlier in recovery phases because they serve a function beyond price. Cycles also change perception. What looks boring during hype becomes valuable during stress. What looked exciting during expansion becomes irrelevant during contraction. Over time, capital learns that difference. That's why assets that survive multiple cycles often look unimpressive right before they outperform. They're ignored, undervalued, and quietly building while attention is elsewhere. Another mistake people make is underestimating how long this process takes. Liquidity resets don't resolve in weeks. They take months, sometimes longer. That time element is what breaks most participants. People lose patience, they disengage, They assume the opportunity is gone, and that's usually when the groundwork for the next expansion is being laid. This is also why long-term positioning is not about blind holding. It's about understanding phases. During deleveraging, preservation matters. During stabilization, accumulation matters. During expansion, risk management matters again. Treating every phase the same is how people sabotage themselves. If this unwind plays out the way similar episodes have historically played out, the market eventually finds a base. Not because sentiment suddenly improves, but because forced selling exhausts itself. Once leverage is flushed and capital reallocates, price stops falling even when news remains negative. That's usually the first real signal that the phase is changing. At that point, the narrative will still be bleak. People will still say crypto is finished. XRP will still be dismissed by most of the market. And that's exactly the environment where long-term opportunity quietly forms. Not in excitement, not in certainty, but in discomfort. Now let's bring all of this together, because if you zoom out far enough, the message here is actually very clear. What we're dealing with right now is not a failure of crypto, not a failure of XRP, and not the end of risk assets. What we're dealing with is a liquidity transition. And liquidity transitions are uncomfortable by design. They expose weak positioning, punish overconfidence, and force markets to reset before the next phase can begin. The biggest mistake people make in these moments is reacting emotionally instead of structurally. They see red candles and assume the thesis is broken. They hear bearish narratives and assume adoption has stopped. In reality, what's happening is mechanical. Leverage is being reduced, capital is being repositioned, excess is being flushed. None of that requires long-term fundamentals to disappear. For XRP specifically, this is where clarity matters. Short-term price action can be volatile and even ugly during macro-driven deleveraging. That does not negate long-term use cases, infrastructure development, or integration into broader financial systems. It simply means XRP trades inside a global risk environment that is currently repricing liquidity. Confusing short-term pressure with long-term failure is how people sell at the worst possible moments. This phase also forces discipline. It rewards people who understand custody, exposure, and patience. It punishes people who overextend, over-leverage, or rely on perfect conditions to succeed. Markets don't need everyone to survive. They only need enough participants willing to stay rational when others lose conviction. What matters now is not predicting the exact bottom. Precision is overrated in these environments. What matters is understanding probabilities and positioning accordingly. Liquidity-driven sell-offs tend to overshoot, exhaust, stabilize, and then reverse long before sentiment improves. By the time the majority feels safe again, the opportunity is usually gone. If you've made it this far, the takeaway is simple but demanding. Respect macro forces. Respect liquidity cycles. Respect the fact that markets move in phases, not straight lines. And most importantly, don't let short-term volatility force long-term decisions you'll regret later. And before we end, it's critical to be absolutely clear. Everything discussed in this video is for educational and informational purposes only. This is not financial advice. I'm not telling you what to buy, sell, or hold. Markets involve risk, and you are responsible for your own decisions. Always do your own research, understand your personal financial situation, and never invest money you cannot afford to lose. If you can keep a clear head during periods like this, you give yourself an edge most people never develop. Not because you're smarter, but because you're disciplined. And in markets, discipline is what survives every cycle.